Taiwan Semiconductor reported quarterly financial results, and the semiconductor manufacturing company gives key insights into big fields in business, including artificial intelligence, that have broader implications beyond the company itself. So, I'm going to discuss several things that investors should know from the company's latest investor update. Let's take a look. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. So Taiwan Semiconductor saying that they spent $30 billion on capital expenditures in the most recent year. And these are investments the company made not just inside or not just in its current region, the core region in Taiwan, but it's also expanding manufacturing outside of Taiwan. The geographic expansion, the management team explained, is because it's something that its customers want. Its customers are looking for some diversification in manufacturing, given the geopolitical tensions and the geopolitical concerns surrounding the United States and China's relationship with Taiwan, and the incoming administration and the politics in the United States over the last decade or so has been going against outsourcing, going against offshoring, and trying to bring back manufacturing jobs to the United States. And this is true for other countries as well. They all want to bring jobs back to their lands. And that's one reason why Taiwan Semiconductor is investing to expand manufacturing facilities to diversify their manufacturing base. So they also said that they expect their business in the first quarter to be impacted by smartphone seasonality, partially offset by continued growth in AI-related demand. And boy, isn't that the truth. And you've probably watched several of my videos on companies in the semiconductor industry, and it looks like everyone is saying the same thing, that everything else is sluggish. Consumer electronics, smartphones, laptops, tablets, all of that is sluggish, but anything related to artificial intelligence is booming. And here we get another data point further solidifying that trend from Taiwan Semiconductor. And this is the most recent update we have, given that the company just released these statements on January 15th. And so yet another data point that AI is still booming, in case investors were concerned that the artificial intelligence trend would level off. So the company is forecasting revenue will grow by 35% at the midpoint in its next quarter, year over year. So the good times expected to continue for Taiwan Semiconductor. They also forecast their gross margins will increase to 58%, and the operating margin will increase to 47.5%. This is from the previous quarter. So year over year, those margins are expected to decline, but from the previous quarter, they're expected to increase. So the company is saying that they guided their first quarter gross margin to decrease by 100 basis points. And part of that reason is the start of manufacturing in overseas facilities. And management has talked about, look, we will diversify our manufacturing because that's what our customers want, but that's going to increase our cost. It's not efficient for us to be producing outside of our core country, but we'll do it because that's what customers want. We're willing to accept lower margins temporarily in order to decrease concentration risk of our manufacturing. That's a strategic decision Taiwan Semiconductor is making. They're willing to do this to diversify, to make sure to give their business more durability, more anti-fragility. If you've read the books by Nicholas Nassim Taleb on anti-fragility, this gives the company more anti-fragility because if there should be some increase in tension between Taiwan and China, then Taiwan Semiconductor has other options to facilitate manufacturing outside of Taiwan. So the precise impact, they say, could be 2 to 3% from the ramp up of their overseas manufacturing facilities. And that's going to be more pronounced throughout the year as their facilities in Kumamoto and Arizona ramp up. Also, inflationary costs, including higher electricity prices in Taiwan, are going to impact their gross margin by at least 1% in 2025. So lots of pressure on their margins in the near term, Taiwan Semiconductor talking about. Now, something I didn't see here and something I was looking for from Taiwan Semiconductor is an increase in prices for them, right? Taiwan Semiconductor increasing prices they charge to customers because they themselves are facing headwinds in their cost. And demand is absolutely soaring. They are producing at nearly full capacity. Seems like an opportune time for Taiwan Semiconductor to go back to their customers and say, hey, we're going to increase prices by 5% or 8% or 10% to offset some of these headwinds they're facing in their cost. But not yet. I didn't see that yet. I saw a little bit of talk about this, I want to say 2 quarters ago from Taiwan Semiconductor, and then it quieted down. I didn't hear much talk about that in the current quarter, in this current conference call. So I'm curious because they do have pricing power. They do have the ability right now to raise prices, but they are strategically choosing not to, which is interesting. It's interesting. I'm not going to sit here and say they should do it because they know how to operate their business better than I know how to operate their business. But given the factors, given the market demand, I thought that they might, or they still will in the next quarter or two, if these headwinds, maybe they're waiting for the manufacturing in these other regions in Kumamoto and Arizona to fully ramp up in the second half of 2025 and then institute a price increase. But I think they are due to implement a price increase. I think it's a matter of when and not a matter of if for Taiwan Semiconductor raising the prices they charge to their customers. So they continue to forecast a longer-term gross margin of 53% or higher, which is curious because in the latest quarter, um, and in the upcoming quarter, they're forecasting their gross margin to 58%, and their margins have been well above 53%. So management is forecasting continued headwinds on their gross margins for the foreseeable future as a result of these headwinds impacting the company's costs. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.